Welcome to 80/20 Estate Planning, the show that explains smart ways to get the most from your estate and planning team, with your host, Al Gibbons. In this 13-week series, Mr. Gibbons and his guests will be discussing a multitude of critical and helpful topics, including his own 80/20 process. Feel free to call in with your questions, 621-WALE or 1-877-621-WALE. Now, 80/20 Estate Planning with Al Gibbons.
Welcome to 80/20 Estate Planning. This is Al Gibbons in the seventh part of our 13-part series. Today I have with me two outstanding attorneys and educators. We will be talking about retirement and estate planning for qualified plans and IRAs. Today I have Ted Kurlowicz with us. Ted Kurlowicz is Professor of Estate Planning at the American College in Bryn Mawr, Pennsylvania. Ted's responsibilities at the college include preparation of text materials and courses in estate planning and planning for business owners and professionals. Ted has appeared on NBC Nightly News, Your Money, a business news broadcast on CNN, The Financial Advisors on PBS, and several segments of Money Matters, a financial planning feature of Nation Business Today. Ted, welcome.
Thank you, Al.
Also with us today is a colleague of Ted's, John McFadden. John is Professor of Taxation at the American College in Bryn Mawr. At the American College, John is a pension, tax, and compensation planning specialist. He is responsible for the college's graduate courses in advanced pension and retirement planning and executive compensation. John is also editor of the college's current handbook for financial service professionals, Financial Planning, the New Century. John is the author of numerous articles and is also co-author of Employee Benefits, published by Dearborn, and Tools and Techniques of Employee Benefit and Retirement Planning, published by the National Underwriter. Welcome, John.
Thank you, Al.
Well, it's nice to have both of you with us. As I said, today we're going to talk about retirement and estate planning for qualified plans and IRAs. Let's come back right after the break.
80/20 Estate Planning will return after these short messages. Mortality. Who dwells on it? But when it comes to planning your estate, it's never too early to start. For smart ways to get the most from your estate and planning team, you need to hear Al Gibbons, creator of the heralded 80/20 Estate Plan. Implement 80% of the planning you need in 20% of the time it normally takes, from A to Z in 60 days. Contact AEG Financial Services today at 610-917-8940 or email them at algibbons@algibbons.com for more information about Al's expert services and related products. Al Gibbons of AEG Financial Services is a highly respected expert in the complicated and often confusing world of estate planning. Put his years of experience in dealing with real situations to work for you. Contact AEG Financial Services today. Call 610-917-8940. That's 610-917-8940 or email algibbons@algibbons.com.
Today's money. It's not just who you are, it's what you're made of. It's not just having a name, it's making one. Not just being, but creating. In fact, 8 out of 10 today's millionaires aren't inheriting their money, they're earning it. That's not just evolution, that's revolution. And one company understands how money has changed, and that company is Phoenix. Call 1-888-456-3451 or visit us at phoenixwm.com, because money is not what it used to be. Money. It's just not what it used to be. Among other things, it's younger. But new money and old money have at least one thing in common. Phoenix, a company that's been helping people manage wealth for nearly 150 years. Phoenix understands that making money and knowing what to do with it are two very different skills. Call 1-888-456-3451 or visit us at phoenixwm.com. We could bring harmony to your life, if not to your music.
Tune in every Friday afternoon from 2 to 3 p.m. for Bit Talk with Len Kaplan. This intriguing program will cover a wide range of issues relating to the world of computing. From computer programming, software, and the internet, this show is sure to educate and inform. If you are just getting started or have been in the industry for years, this show has something for everyone. So tune into your Talk Alternative every Friday from 2 to 3 p.m. right here on 990 AM. And feel free to visit www.cdml.com to leave your questions and comments regarding this exciting show. Just go to the online forum in the radio section.
If the words hardworking, dedicated, and professional describe you, then we here at WALE might want you to work behind the scenes and learn radio. Invest in the opportunity for you to join us in the exciting world of radio. You can go further than you ever dreamed of and have fun doing it. What are the requirements? Call North American Broadcasting Company during normal business hours at 401-521-0990. That number again, 401-521-0990 for more information. Or send your resume to us via the email at nabradio@aol.com. In the Army National Guard, serve part-time.
1 weekend a month.
Enjoy life full-time.
College, career.
Check. Call 1-800-GO-GUARD. www.1800GoGuard.com.
In the Army National Guard.
Sponsored by the Rhode Island National Guard. Aired by the Rhode Island Broadcasters Association and this station.
Join Carol Ann Brown from Money Talk every Wednesday afternoon at 5 p.m. Carol Ann is the acclaimed author of 100 Questions Every Working American Must Ask, The Money Manager, and her new book, 12 Great Investment Strategies to Improve Safety and Income. You probably saw Carol Ann's column, Paycheck Finance, in the Providence Journal, or have seen her as a guest on CNBC and CNN. Carol Ann is the host of Money Talk on CNBC and Bloomberg Radio. Carol Ann is a certified financial planner and a registered portfolio manager. Now she is here on Whale in Providence to answer your questions on anything to do with money. Wednesdays at 5 p.m. Tune in.
Hey, buddy, do you really want to whack that pile of 2x4s with the part of your body that you think with? Like I was saying, there are easier ways to prove you're a man. Registering with Selective Service when you turn 18 shows that you're a man and preserves your chances for college loans, job training, and government jobs. And it doesn't hurt a bit. Register with Selective Service online at www.sss.gov.
Tune into your Talk Alternative every Friday from 6 to 7 p.m. for Solomon Smiles with your host, Dr. Frederick Solomon. If you have any questions or curiosities about the world of dentistry, this is the show for you. From aesthetic dentistry to family and cosmetic dentistry, this show has it all. This interactive call-in program is your free ticket to the dental clinic. You can also visit Dr. Solomon's website at www.solomonsmiles.com for further dental information. So join us every Friday from 6 to 7 p.m. for Solomon Smiles, right here on your Talk Alternative.
If you own a business, work for a business, or need career advice, Ask the Business Doctor is the radio program for you. Saturday from 5 to 6 p.m., a team of management consultants are on duty and ready to take your call. If you need help with a business-related problem or seek career advice, the doctor is in every Saturday from 5 till 6. Take advantage of this opportunity to grow your business and advance your career. Tune in to Ask the Business Doctor, Saturdays from 5 to 6 p.m., right here on your Talk Alternative, WALE 990.
We describe things based on our experiences.
When an asthma attack comes, I just feel horrible.
When a child tells us how he feels, he uses words from his world.
It's like an elephant standing on my chest.
Children don't speak to sell, they speak to share. Look for the American Lung Association envelope in your mailbox. Find the Christmas seals. Help find a cure for asthma. Call 1-800-LUNG-USA.
Brought to you by the American Lung Association.
And now back to 80/20 estate planning. Here's your host, estate planning expert, Al Gibbons.
Welcome to 80/20 estate planning. Let's try it again. Technological difficulties the first time around. Let me reintroduce our two guests today. Ted Kurlowicz, professor of estate planning at the American College in Bryn Mawr, Pennsylvania. Ted's responsibilities at the college include preparation of text materials and courses in estate planning and planning for business owners and professionals. Ted has appeared on numerous television programs regarding financial and estate planning, and we're happy to have him with us here today. Ted, welcome.
Thanks for inviting me, Al.
Also, Ted's colleague and another good friend of mine, John McFadden, professor of taxation at the American College in Bryn Mawr. At the American College, John is a pension, tax, and compensation planning specialist. And he's responsible for the college's graduate courses in advanced pension and retirement planning and executive compensation. He is also editor of the college's current handbook for financial service professionals, Financial Planning, The New Century. Welcome, John.
Thank you, Al.
It's nice to have both of you with us. Today we're going to be talking about retirement and estate planning for qualified plans, IRAs. And this is a really hot topic now, gentlemen. A lot of changes taking place, and we want to bring our listeners up to date. In light of the theme of this show, Ted, where we try to do 80% of estate planning in 20% of the time, can we do that with retirement planning?
Well, that's a good question, Al. Of course, you can look at the client's goals, and you can look at the individual goals needed for the family and merge in these new tax rules with respect to distributions. And for most individuals, once you know what their goals are, these new rules provide you with a minimum guideline on how late you can take your retirement payments if you want to avoid income taxes as long as possible, and how little you can take in any given year. So outside of that guideline, which provides the minimums, you can virtually do what you want to do to take more if that's what the retirement needs specify, within the guidelines that I'm sure John will address about taking early distributions. So as long as we know what the target is, the rules really provide us with the most flexibility possible because they give us the longest potential period to take our money out.
John, you and Ted teach courses in estate planning and qualified plan design and so forth, and I can tell you that as a practitioner, it is a scary landscape for me and for my clients because it has always been so complex, especially this area of distributions and naming beneficiaries and so forth. It's been complex, and the rules seem to change all the time. Is this really, these new rules that have come out, do they really make things simpler, or is it as complicated as ever?
Well, it's still complicated. I don't want to oversimplify anything, but the new rules, I'll tell you what, the real advantage of the new rules is that they uncouple the issue of distributions during your lifetime from the issue of what you want to do with the remainder of your qualified plan distribution after your death. The old rules tangled those two issues up together in such a way that it really complicated estate planning with qualified plans.
Well, now, can you give me a simple example of that?
Well,
how it was complicated before?
Well, the rules before handcuffed you.
This is what's happened is, I guess everybody knows that when you reach age 70 and a half, or in some cases retirement, you have to start taking money out of your qualified plan. And there's a bunch of rules called the minimum distribution rules that determine the minimum amount that you can take out without penalty. And it's a pretty stiff penalty, so you have to be pretty careful about complying with these rules. Well, under the old rules, you had to make some decisions about who your beneficiary was that were really locked in such a way that if you could always change your beneficiary, but it would also change the amount of minimum distributions that you took. In addition, you had to make some choices up front, often without really good guidance from appropriate advisors, as to how to take your minimum distribution, and sometimes these choices were not good choices. For example, there was something called a recalculation election, and if you weren't careful, you could take this in such a way that if you died before your spouse did, then all of a sudden, before your spouse or beneficiary, then when you died, all the rest of the income taxes on your qualified distribution would suddenly become due. There were all kinds of traps like this in the rules. The new rules
it's sort of like dominoes.
Exactly.
One thing could happen and it affected everything else.
That was exactly what was wrong with the old rules. The new rules are really much simpler. You only have two choices.
I like hearing that, John. Much simpler.
Well, of course, you have to realize I'm not an estate planner. I do mostly advising people while they're still alive.
And so I should have quickly asked Ted, much simpler, Ted?
I wouldn't say much simpler. What I would say is it provides, from the estate planning standpoint, all of the complexity that existed before continues to exist, but what it provides you with now is the opportunity to make choices that you were unable to make before, because the distribution planning that John is talking about for people during retirement does no longer locks in your choices after your beneficiary's choices after you pass away. So the complexity is still there, but you now have more opportunity to make appropriate choices that didn't exist before.
So what Ted is saying then, John, if I could summarize this or say it in a different way, is that the decision-making tree is a little more clearly defined, and the timing of issues isn't as locked in or as connected as it was before.
That's right. In fact, most people won't have any decisions at all to make when it comes time to take their minimum distribution. Most people will have minimum distributions governed by one single table, regardless of who their beneficiary is.
Well, that's already a big change, John.
That's right. And the only exception to that is if you happen to have a spouse who's more than 10 years younger than you are.
Okay, let's come back to that. Ted, from an estate planning perspective, why are we talking about taking minimum distributions? We usually think about taking the most dollars that we can take out of these kind of things. Why are we talking about minimums?
Well, the target guidelines, and when Congress gave us the ability to fund pension plans or IRAs to the extent that we have, the goal for the tax law that created these minimum distribution rules was to allow people to save for retirement, but use the laws emphasize the importance of using the money for retirement, and rather than using the money to fund inheritances. So there are multiple taxes that exist on this type of asset at death that would not exist on another asset. The income taxes built into the distributions from the qualified plans do not go away at death. So we might have what is known as the federal estate tax, in some cases state inheritance taxes imposed on what's left in the retirement plan or IRA at death, but we also have the income taxes that continue to have to be paid. So when we're discussing minimums, the reason is most individuals who have saved in their retirement plans and saved in other aspects of their financial plan, if they have more than enough to live on, they would choose not to take money out of the retirement plan to delay the distributions for income tax purposes as long as possible. So the government,
taxes.
Right. So the government had to put minimum distribution rules in to more or less force people to use the money for retirement. And the minimum distribution rules say, for retirement purposes, once you reach age 70 and a half, or if you're in a qualified plan and you're not a 5% owner of a company, when you actually retire, if that's later than age 70 and a half, you must begin taking distributions, and you must take at least as much as the table that John referred to would specify. But
and actually, some people get a little confused by this. You don't actually have to take the money out and spend it. All you really have to do is take it out of the plan, pay taxes on it, and then you can put it back in savings again, but it's no longer part of your plan.
So as I understand it then, John, where we stand here is that the government has given us an opportunity to put away money for retirement on a tax-favored basis. And they say that's what we want you to use it for. We're not going to delay taxes forever. We're not going to make it easy for you to leave to other people. And so we're going to force it back out of that plan starting at 70 and a half. And this is sort of the issue that's going on. And people are concerned about minimums because for two reasons. Number one, they think they'd like to leave as much money as they can to their families. That would be one of the reasons. Continue to get deferral. But I guess the big problem here is that if you don't get it out in the right way, and if you don't get enough money out, minimum, hence minimum, then there are some penalties, and they're rather significant. Is that true?
That's right. The penalty basically is 50% of the amount that you should have taken out but didn't. So if if your minimum distribution for the year is $40,000 and you only take out $30,000, you've got a penalty. Well, not only do you have to take the additional $10,000 out and pay income taxes on it, but you got an additional penalty of 50% of that $10,000 that you didn't take out.
So if I didn't take out any of the 40,
then there's a penalty of 50% on the whole shebang.
So I have to take the 40.
You got to take the 40 and pay taxes on it.
Plus have a $20,000 penalty.
That's right.
yeah, the interesting.
Now it's clear.
The interesting point. With all of the goals that Congress put here for us, the interesting point of these new changes is you can take it out or must take it out as slowly as anything that was ever permitted under prior law. And to give you an example with numbers, somebody with a $1 million account balance who's age 71 only is forced to take out a minimum of $32,650 this year. And the way the new rules work with the calculation, if you never take more than your minimums, even though Congress originally created the retirement plan tax rules to allow you to save for retirement, the way these new rules work is it's much more likely, because you're taking the money slower, and the way the calculation works, the account balance should never drop to zero. So we almost always have to consider how to treat the inheritance from one of these plans.
Well, what really happened here was that originally, when the new rules were put in about 12 or 13 years ago, there were a lot of options. And if you were well advised and had smart advisors, you could figure out a way to take out the smallest possible amount. But the IRS finally decided that this wasn't really fair. And so essentially what they've done with the new current rules is they allow everybody to get the same result that formerly you had to have the smart advisors for.
Well, Ted, when you say it's $32,000 this year, well, what would that have been comparable to? What would the minimum been before?
Well, that would have been the only way that would be less than that, Al. $32,650 would have been the minimum for that person before. Right. Based on elections that they made at retirement. The only time it could be lower than that is if somebody was married to somebody more than 10 years younger.
Okay, we'll come back to that one.
But in the past, there were multiple options to take a minimum distribution. If you chose to name a beneficiary that would allow you to take a 2-life payout, a joint survivor payout from the plan, you might have had to take almost twice as much money out using an individual life expectancy. So in the past, the $32,650 was an available option for for some people making those elections, but many of the other options that used to be choices would cause you to take it out much faster than that rate, maybe as much as twice as large a distribution.
So overall, this is good news.
Oh, it's very good news because you always have the flexibility to take more than the minimum, but it now allows everybody, regardless of what they think about any of their beneficiaries, to take the maximum extended period to withdraw from their plan. In other words, delay income taxes as long as possible throughout their lifetime.
There is one downside in the new rules, though. In the old days, I'm not sure how many people ever paid that big penalty tax, because I'm not sure how many people ever got caught. But under the new rules, the person who holds the money has to notify the IRS what your minimum distribution is.
Well, so compliance is a little bit more out in the open, right, John?
That's right. You're going to have to really take those minimum distributions.
Well, what we need to do is take a break, but I think what I heard Ted say was that there's always going to, or not always, but often there will be money at death.
Yes, that's a very important factor.
So I think we'll come back and we'll talk about estate planning with qualified plans and IRAs right after the break.
80/20 estate planning will return after these short messages. Mortality. Who dwells on it? But when it comes to planning your estate, it's never too early to start. For smart ways to get the most from your estate and planning team, you need to hear Al Gibbons, creator of the heralded 80/20 estate plan. Implement 80% of the planning you need in 20% of the time it normally takes, from A to Z in 60 days. Contact AEG Financial Services today at 610-917-8940 or email them at algibbons@algibbons.com for more information about Al's expert services and related products. Al Gibbons of AEG Financial Services is a highly respected expert in the complicated and often confusing world of estate planning. Put his years of experience in dealing with real situations to work for you. Contact AEG Financial Services today. Call 610-917-8940. That's 610-917-8940 or email algibbons@algibbons.com.
Today's money. It's not just who you are, it's what you're made of. It's not just having a name, it's making one. Not just being, but creating. In fact, 8 out of 10 today's millionaires aren't inheriting their money, they're earning it. That's not just evolution, that's revolution. And one company understands how money has changed, and that company is Phoenix. Call 1-888-456-3451 or visit us at phoenixwm.com, because money is not what it used to be.
Tune in to WALE every Saturday afternoon from 1 till 2 and join BJ, the Cyber DJ, on Cyber On America. Joe Chismerick, your host, will be discussing the Internet and its social ramifications. From doing business on the Internet to the dangers of the Internet, Joe and his great guests will discuss it all. So don't miss Cyber On America every Saturday afternoon from 1 o'clock till 2, right here on WALE Renaissance Radio.
Are you having constant problems with your pet, like tearing up the furniture or going to the bathroom where they're not supposed to? Then it's imperative that you listen to Animal Coaching with Maureen Hall every Thursday morning at 9.